Hi everyone, and welcome to our presentation on asset impairments, amortization, and big baths. In this presentation, we will cover the concept of big bath and how it has been used by companies globally. Furthermore, we'll also discuss the benefits of both sides of the debate in terms of flexibility to charge impairments on assets, as well as requiring companies to depreciate or amortize their assets according to a prescribed schedule, and then finally weigh out both approaches from a regulatory perspective. So let's start with big baths. This name means to wipe a slate clean. It is essentially an accounting concept where a business takes on a very large one-time write-off on their assets. The intent behind a big bath is to take on increased loss on earnings in the current reporting period so that future reporting periods look more profitable. This is often employed by management during periods of business downturn to hide persistent headwinds for future reporting periods. Here is a simple breakdown of the accounting effects of big bath. First, the business is already reporting losses for the period. Therefore, they take on a very large one-time write-off on their assets, and this increases their expenses for that period, which in turn reduces their earnings for that period. Samsung is a great example of how big bath accounting can be used to benefit future performance. In Q4 of 2008, Samsung started feeling the effects of the GFC and the subsequent credit squeeze following the collapse of the Lehman Brothers Bank. It saw sales drop across all its product range. There were essentially two main reasons for taking on the big bath for Samsung. First, the evaluations of Samsung executives finished in late November, so there is no incentive to make fourth quarter performance look good. Secondly, domestic brokerages expected Samsung to turn a positive territory in the first quarter. Therefore, a big bath in Q4 seemed the ideal time to start with a clean slate. So Samsung did this by aggressive write-offs in cash, attributing those losses to marketing and management costs. As seen in the figure, Samsung wrote off 4.42 trillion won in cash through these costs, which was 35% higher than the previous quarter. The benefits of this flowed through into the next quarter, where Samsung reported earnings of 619.20 billion won. This can be attributed to the additional write-offs previously, leading to a savings in the expenses in Q1, and consequently a better performance compared to the clean slate during the big bath. Similarly, we also have the example of a bank taking a big bath to achieve a more competitive profile. Low-yielding fixed-rate investment securities had made up a large portion of Fifth Third's interest-earning assets. That mix became unfavorable in 2006 when short-term interest rates began to rise. The bank had also relied heavily on wholesale borrowings opposed to customer deposits, consequently resulting in narrow interest rate spreads between assets and liabilities and the added pressure on net interest margins. Therefore, the bank decided to restructure its balance sheet by selling more than $11 billion worth of investment securities from a portfolio of interest-earning assets. The losses associated with these and other balance sheet changes reduced earnings by nearly $0.53 per share. The effects, however, resulted in a 3% increase in Q4 net interest income. Net interest margin also went up by 0.17%. And it is expected to be far greater in 2007. Future outlook is also positive, and easy comparisons to the time when they took the big bath will help deliver strong profit growth. I'll now pass it over to Daanial. Thank you.
So, granting managers the flexibility to charge impairments on assets can pose several advantages for the organization, including having discretion over the outlook of financial statements and future expenses, crisis management, and strategic decision-making. In terms of discretion over the outlook of financial statements, AASB 136 imposes the requirement that the carrying amount of an asset should not be carried at a higher value than its recoverable amount. Hence, this downward movement in the value of an asset is recognized as an impairment loss or loss on reevaluation under the income statement. Managers can in turn reduce the amount of depreciation paid in the future and further increase profits, making financial statements look more appealing to investors and creditors. For example, as shown on the slide, an asset with a carrying amount of 1 million, with 5 years remaining on its useful life, and a recognized recoverable amount of 500,000, decreases depreciation expense by 100,000, assuming the straight line method with no salvage value. Hence, this reduces expenses and increases profits by $100,000 in next year's income statement, increasing the confidence of investors and creditors. Furthermore, managers can also have the discretion to effectively create a deductible temporary difference, which can reduce income tax paid in the future. According to AASB 112 and ATO, impairment losses are not deductible for tax purposes. Hence, managers reducing the value of an asset from its carrying amount to its recoverable amount can effectively create a deferred tax asset. Looking at an example provided by AASB, if an identifiable asset had a carrying amount of 1,000 with a recoverable amount of 650, and let's say if the tax base of the asset is 800 and we assume a tax rate of 30%, we can see that the effect of the impairment creates a DTA of 45 as opposed to a DTO of 60. This is shown with the new carrying amount of 650 minus the tax base of 800 multiplied by the tax rate of 30%. Hence, managers can utilize this 45 DTA to reduce taxable income in the future, which a company can use to its advantage to align with long-term business goals. In terms of crisis management, AASB 136 paragraph 12 identifies several factors indicating the impairment of an asset, including external and internal sources. As managers have the flexibility to assess these sources, such as market value declines due to poor economic conditions, having flexibility to charge impairments on assets can maintain the overall health of the business in the long term. For instance, managers can effectively blame the company's poor performance on the pandemic, increasing the confidence of future investors, hence maintaining the life of the business and continue to contribute towards the output of the economy. In terms of a shift in the company strategy, an example can be seen through BHP. BHP's results of the half year ended 31st December 2020 showed an impairment loss in relation to its energy core assets of US 1.6 billion. However, as evident in 2018, BHP has been heading towards a different strategy regarding taking steps away from thermal coal, with instead a focus on commodities that are more sustainable. Another way this advantage can be seen is if a company has a change in CEO, whereby charging impairments on assets may shift the blame to past company decisions and past CEOs and grant users of financial reports more confidence regarding the company's prospects. James will now take over.
Depreciation refers to the costs associated with typical wear and tear of assets over time and is typically accounted for through the use of a depreciation or amortization schedule. AASB 116 defines depreciation as the systematic allocation of the depreciable amount of a tangible asset over its life. Similarly, AASB 138 defines amortization as the systematic allocation of the depreciable amount of an intangible asset over its useful life. This depreciable amount represents the decrease in service potential of an asset as it gets older, less effective, and/or less efficient. The use of scheduled depreciation and amortization expenses relating to non-current assets are widely utilized by both listed and non-listed companies globally as a method for accounting for the periodic usage of their non-current assets. There are a number of advantages to implementing a system for the depreciation of assets for both internal and external stakeholders. Some of these advantages include the matching of revenue and expenses, improved budgeting and financial planning, the generation of tax savings via tax deductions, and improved asset evaluation systems for internal and external stakeholders. The use of depreciation schedules enables companies to classify depreciation as an operational expense, enabling stakeholders to quantify the costs associated with the usage of a firm's non-current assets. For example, Qantas Limited depreciated their assets by upwards of $1.9 billion in the year ending June 2021. This enables external users, such as investors or creditors, to gain a greater understanding of the nature of a firm's assets and their usage in relation to the company's revenue, which is typically listed in the lines above. The use of scheduled depreciation also relates to AASB's requirements, specifically to the presentation and preparation of financial statements, in that depreciation allocation procedures should recognize expenses in the period in which the economic benefits associated with these assets are consumed. This enhances the usefulness and understandability of an organization's financial reports by enabling a greater level of understanding of the expenses associated with a specific organization's operations. Similarly, depreciation scheduling is advantageous for the internal stakeholder. Scheduled depreciation enables an organization to match its revenue generation with the associated expenditure far more effectively than if no depreciation scheduling was used. This provides a more accurate representation of the profits of a company, as costs that would otherwise be hidden in the initial cost of an asset are accounted for on a basis that best represents the usage of an asset. This also facilitates better financial planning and budgeting, as it allows for firms to more effectively plan for the eventual disposal and replacement of the asset. Additionally, the use of a depreciation schedule enables internal and external stakeholders alike to have a more accurate understanding of the value of a firm's assets and the level of future economic benefits existing assets are expected to generate. Finally, the use of depreciation scheduling enables firms to generate tax savings by offsetting their revenue with associated depreciation expenses for the period. Due to the various depreciation methods available, firms have a great deal of flexibility in matching a depreciation method to the pattern of usage of their assets, and thus flexibility in relation to the tax savings that they can generate from the depreciation of their assets.
As Daanial and James have discussed, there are distinct advantages to both granting financial managers the flexibility to impair their assets, as well as asking them to use a set depreciation or amortization schedule. The major advantage of granting managers the flexibility to impair is that this allows the company discretion over their financial statements. This means that in the event that they spot an overvalued asset, they are able to use impairment loss expense to bring that asset down to its carrying amount in line with AASB 136. Other advantages include increasing the ability for a business to mitigate a crisis, as well as its strategic decision-making. For a set depreciation/amortization schedule, advantages include the matching of revenue and expense, budgeting and financial planning, tax deductions, and asset valuation. Now, this is a lot. So to determine which of these methods would be preferable from a regulatory perspective, one must recall the accounting regulations purpose in the first place, and that is to present fairly the financial position, financial performance, and cash flows of an organization. Whichever method that our group decides is preferable must more strongly lead to a fair presentation of the financial position and performance. With this in mind, we can examine the dilemma of the decision. Giving managers the flexibility to impair their assets in theory allows for a more accurate reflection of an asset and thus the flexibility and thus the business's financial position. However, that same flexibility is like a dual-edged sword, as it can lead to the big bath situations like Samsung in 2008, which were covered earlier. As a manager can rather easily exploit the flexibility given to them if the scenario suits. On the other hand, having a set depreciation or amortization schedule removes entirely the opportunity for a manager to conduct any big bath scenarios. However, it implies a scenario such as the COVID-19 pandemic, a company that has assets affected by the pandemic, for example, airplanes, would be then unable to reflect the financial position of their company accurately, leading to an overstatement of the financial position. From the regulatory perspective, this means that companies will inevitably be overstated, whereas not every company is going to participate in unethical accounting practice. And to this end, our group has concluded that despite big bath taking advantage of them, impairments on assets are, from a regulatory perspective, preferable to a set schedule of depreciation/amortization. However, our group believes that from a regulatory perspective, correct usage of both methods should be encouraged for the true best reflection of financial statements and position, meaning while a company does have the flexibility to impair their assets, they should do so responsibly and at the same time still use a depreciation or amortization as needed. Thank you.